Okay, so welcome everyone to our SEM virtual seminar series. Today we're super happy to have Terry Hendershott presenting True Cost of Immediacy with Dan Lee, Dmitry Livdan, and Norman Shurov, who are also in the audience and will be answering your questions or will help Terry answer questions from the audience. And we're also super happy to have today our regular board members, senior board members, as well as panelists who've graciously agreed to join the talk. And their role today will be to help create a lively discussion during Terry's talk. And you can kind of read the names probably faster than I can say them. And let me remind you of the seminar format. The talk is 1 hour, followed by 15-minute Q&A. During the talk, please feel free to post, especially if it's clarifying questions, to the Q&A, and I'll have the co-authors answer those questions during the kind of in the Q&A part. And during the Q&A portion of the segment, either raise your hand and we'll unmute you to answer the questions. Or just type your questions, and we'll, I apologize in advance if we don't get to all the questions during the Q&A segment. And let me also remind you of 2 upcoming talks and workshops. Our next seminar speaker on March 22nd is Boyan Jovanovic, and the Friday of that week, we'll also have a workshop on the housing market. Okay, so with that, I'll pass the floor to Terry. Terry, please take it away.
All right, thank you very much, Meg. Thank you very much for, where, it's not offering me the
share screen is gonna be on the bottom of the.
Yep, no, I understand that. Oh, I know what the issue was. Okay, all right. You'd think after the number of online seminars and teaching I've done, I would have this down. All right. And let's see. And then I'll try and turn on my annotation to the extent that I want to spotlight something. You can see where my mouse is now, right? Mm-hmm. Okay, great. So thanks for having me. We were talking before everyone got on about how we're basically entering a year of lockdown, and giving seminars over Zoom is almost starting to seem normal, if still not ideal. And it'll be interesting to see how much we go back to the old ways. So for the paper today, the title and subtitle try and say it all, right? We're going to talk about the cost of immediacy, and we're really going to be focusing on the opportunity cost of not trading. So this is something important. People have understood that it's out there, but I don't feel like it's been really well answered question related to measuring liquidity when we only observe trades, right? Where investors are endogenously choosing not to trade when they'll receive bad prices. So, you can certainly imagine you're going to get selection, and you're only going to see good prices, and liquidity will look good, even if it's very hard to trade. So for those of you who've seen the paper before, we have some new methodology that's not yet in the paper that I'll focus more on today. Okay. And now, right, so quick motivation. So in our setting, and this is how we're thinking about it, how it really works. And this is also true for lots of structured products, how they're traded. So it really starts with the seller. And so the seller is going to run an auction or have someone run an auction for them, where the banks or dealers are going to bid. So there'll be N dealers. Then the mechanism is going to be a first price sealed bid auction. So these are often referred to as RFQs, for requests for quotes, or I'm going to use the term bid wanted in competition, BWIC. And OWICs exist where it's basically the buyer comes, but they're much less common. So the BWIC terminology is very similar, is very prevalent because, as I said, this is how a lot of trading works in these less liquid OTC markets, where it really starts with a sale. Okay, so if the best bid is going to be high enough, then there's going to be a trade. So the owner has a reservation value. And if the highest bid isn't above that, there won't be a trade. So if the trade's successful, then the owner can the dealer can then liquidate the asset for the ask that's greater than the winning bid here. So the seller is going to receive the best bid, and otherwise they get R when it fails. So they're going to still hold on to the asset if they don't. So, and there's not a lot of evidence that when people fail, they successfully trade after that. So while we're thinking of this as sort of a one-shot transaction, there's not a lot of evidence when people fail, they resell. So the expected proceeds. So when the trade occurs, well, we get the expected bid conditional on trade, and if not, we're going to get the outside option. So you can, a little bit of algebra, we can rewrite this to what we're calling TCI. It's just the ask minus the proceeds, and that you can write this as a term for what we typically observe, which is the ask minus the bid, or the observed bid-ask spread conditional on trading occurring. And this is basically, the second term is failure cost, and then we multiply it by the probability of failure. So we're going to use the ask price as sort of a benchmark price, because that obviates the need for us to try and have a model of fair value, which is often very hard to come up with in the illiquid structured products. So, you know, lots of work has been done on the bid-ask spread. People have thought about opportunity costs a lot, but that's, you know, we're going to hopefully have something new to say about it. And that's what I'm really going to focus on here. So,
hey, Terry?
Yes.
Just real quick, could you just briefly talk about how this approach and this concept differs from the idea of implementation shortfall?
I'll talk about implementation shortfall in a couple of slides. So certainly when I'm mentioning that people have known about this, people have known that there are opportunity costs of not trading. And conceptually, you know, this goes back to Perot's article, but the measuring of it has been a real challenge, because you need to know when they fail, and then you need to come up with an estimate of what the costs were when they fail. So empirically, this has been a real challenge, and I'll talk about that a little more. So conceptually, people have known about the problem. Now, I'm going to be agnostic about, you know, why whether or not the dealers are bidding for themselves, or they're actually bidding for their customers, who are going to be the end buyer of the asset. So, you know, the seller, they just care about whether or not the bids are low. And I'm also going to be agnostic about why the bids might be low. So this could be non-informational frictions, or it could be informational frictions. It's just bids are too low. So we're going to estimate this for the average seller. And that's the part where I'm going to spend more time talking about, you know, what do I mean by average seller, and why do we do that? Okay. Estimating cost of immediacy. So right there, if there are no firm quotes for all trade sizes, you know, if you had them in a centralized market, you could measure them precisely. OTC markets have had, you know, their data availability issues. We can do sort of these role models of transaction prices. People have looked at round trip trading costs for the dealers. So there's some things you can do. And then centralized markets, right? This was related to Amy's questions. We get these continuous firm quotes, but they're for very small sizes. So the large orders end up being broken up into small trades over time. You know, there's data that links together the small trades into larger orders, but this data has historically not captured the unfilled orders. You just see, well, what the person traded, and then you have to think about, well, you don't know how much they wanted to trade but weren't able to, and then you have to think about what benchmark price you might use for that. And this, you know, particularly if the optimal trading strategies are price contingent, this is really going to bias things down, because you're going to see larger trades when price impacts occur. And so this is generally, we've known about opportunity costs for a while. Okay, so to think about what we're doing, so our specific setting is going to be the CLO market, and you're going to see a number of these graphs that we're going to that I'm going to talk about. So so we're going to have what we're measuring on the y-axis, and then time on the x-axis, and we're going to split everything up by tranche. So we've got the senior, sort of the AA and AAA stuff, the intermediate stuff, and then the junior or equity or junk stuff. And so this is going back to the onset of the pandemic last year. And you can see, so the red line is the bid-ask spread, which is for basically the difference between the bid and the ask, or the buy and the sell price for a dealer on round trips less than a day. And you can see how, going into the pandemic, these were low and pretty stable, 5 to 10 basis points. Then as we enter into the, as we started to realize stuff was really happening, and then when we went into lockdown, or the two gray areas, pretty close. So you can see how the spreads went up. They go up, but in junior, they didn't go up as much as I might have expected, but they go up, but they still remain pretty modest. So they're under, 40 basis points or less, which for an illiquid product in a very stressful time seems to potentially to look like the market performed remarkably well. However, go ahead.
I have a question about this bid-ask spread thing. It seems to me that the way you estimate it basically creates a downward bias on the estimate of the spread, which gives a much greater role to the failed trade. And the reason is that you're using, of course, just 61% of the transaction, right? Those where, there's less than 1 day. So what are the arguments against using, let's say, 100 days? One of them is that maybe you are mismeasuring, right, the buy and the sell. But when you've got 11 trades on average over 8 years in each issue, that's probably a non-issue. The other thing is about the market movements. But if the dealers are rational and risk averse, the compensation they require for the immediacy should take into account that on 39%, they'll have to, carry it in inventory. So using the realized prices, right, what happened eventually, may not be a bad idea. So it wasn't clear to me why that's a good choice for the paper, because in some sense, what I think would happen is that you would get a much larger estimate of the spread. It doesn't mean that the fails to trade are not important. It may be important, but a lot of the magnitude and the fact that it will go up a lot in those intense periods could be also probably shown in a different bid-ask spread measure that takes into account the inventory cost.
Well, we actually started off trying to do that. So we started off looking at all the round trips we could measure. So if you're going to do bid-ask spread, if you can see the same dealer, and this is the advantage of having a co-author at the Fed who has the real data, you can see when the same dealer bought and sold, you can measure things well. It turns out if you use a longer horizon to measure these, they don't go up. They end up going down. And this is because the dealers often accumulate inventory when prices are falling. So, in some sense, I agree in theory, our approach could bias things upward. In practice, it doesn't. So our goal was not to make the bid-ask spread look small. It was to make it look sensible and not have it be negative. This is not to say there isn't some other way we could try and estimate it more precisely. And there is another paper by Gary Gorton that focuses entirely on the bid-ask spread for the collateralized loan obligations. And they're not getting crazy different numbers. Their numbers, I think, are a little bit higher, but they're also looking at the non-bids wanted in competition trades as well.
Gary, let me follow up with Gideon's question, which is, are you actually measuring the bid-ask spread? Are these effective spreads? Are these realized spreads? Or are they quoted spreads? Or are they something else?
So we don't have quotes. These are basically the dealer round trip profits or revenues.
So really realized spreads at the end of the day.
Yeah.
Okay.
Right, because if you're going to try and do an effective spread or something, you need to model fair value at the time of the trade, which is tough in these markets that trade. As Gideon already pointed out, if it trades 11 times over an entire sample period, that's going to make it difficult. Okay.
Sorry, if I could just as a clarification, so the way I should think about it is this R that you had floating around on the previous page is independent of what's being sold and the proportion of what's being sold?
So we'll eventually, right, so I, of course, wanted to start us with a very simple example that's easy to come up with, where we could think of as just one asset and there's an R. Now, in practice, we're going to be conditioning on a lot of the observables, right? You can see here, we've already estimated it by senior, mezzanine, and junior. So we did those separately, but then we're going to put in the specific ratings, the size of the trade, a bunch of market conditions and other things. So there are going to be both market conditions and trade characteristics that are reflected here.
May
Is
I
that your-
ask just also a clarifying question in terms of what the objective is when we measure here immediacy? I would have thought about immediacy as measuring how much can I trade per time unit, and what is the price schedule as a function of the quantity that I trade per time unit, because the immediacy is really about the timing. How quickly can I offload a large quantity now versus later? And it seems in this measure itself that that time dimension is completely omitted and the quantity dimension is not present. So I wanted to clarify in what sense this is. The subtitle I understand better of your title of your paper, which is the how large are the costs of not trading. But in terms of immediacy, that's somewhat of a different concept, which has to do a lot with timing and the quantity that you trade per time unit.
Well, that's right. So you're thinking of a market where you can actually trade. And then maybe if I try and sell my, so let's see, in this market, these auctions are going to last from 1 to 3 days. And if you don't trade, you just don't trade. Meaning that, right, we don't see sort of the same QSIP being sold a day or two later after the BWIC is run. That happens. We've got some data in an appendix, I don't know, 5% of the time. So it just looks like failure is an option here. So the time is infinite. So we do have things on the bid-ask spread. You can think of this as being measured as a function of quantity desired. And then that can be incorporated into this as well. But yeah, we're mostly focused
I guess
on
quantity at least would be also a part of it, right? I mean, how much you're going to try to trade should have an informational impact. You're going to trade a marginal unit at a certain price and a certain bid-ask spread versus a very large quantity. The meaning is quite different in terms of immediacy that you're getting.
Yeah, we do have estimates on the bid-ask spread. These trades are on average pretty large, and I don't remember I don't have tables in here. I just have pictures to try and make, to not make people's eyes glaze over. But I don't remember the quantity being playing a big role in the spread.
Carrie, why does it take so long to run these auctions? It seems too long to me.
Well, so these are variable rate securities, right? So they're going to be, you don't really face interest rate risk over time. I mean, I guess this is right. So I've written a different paper on that did RFQs, that did in the corporate bond setting. And they're almost always 5 or 10 minutes, which may be what you have in mind, Charles. This is a much less liquid market. I mean, that's my only explanation. And it could well be that the dealers are really going out as opposed to bidding and planning on taking it into their inventory. They're really going out and looking for an end buyer. And so it takes a while to contact people who they think might actually be willing to buy the asset.
Fair enough.
Well, if you have a better example, why, but this is of course super interesting thing from a theoretical perspective, and to the extent we have time at the end, does this mechanism make sense? All these sort of things. I'm just, we originally had an auction model in which you can derive all these things, but then we decided, look, this is much more general. This idea here is pretty straightforward, and it does focus on you just don't trade, even if you sort of leave the price out there for 3 days or leave the quantity out there. Okay, so here's going to be our TCI measure, which is basically going to be our empirical estimate of, the first part, which I just showed you, and then adding the second part, which is fill rates times fill costs. And you can see that, it's a lot higher for senior, it's higher for mezzanine, but you have to remember that y-axis here. In general, I won't change the y-axis. Well, sometimes I will and sometimes I won't across the 3 different columns. And you can see how, mezzanine's going up to 4% and junior's going up to 15%, right? So there's, the TCI and the bid-ask spread are varying a lot in the cross section and in the time series, right? It increases in senior, in mezzanine, but it just blows up in junior. And why is that? Well, the failure rate in the junior, which I have all the details for this time period at the end of my slides that I can show, and we can either go through quickly or slowly, depending upon how we're doing. But the failure rate in April here is coming up to 60%. So there are a lot of BWICs that don't, that just don't trade in the junior in stressful times. And in other stressful events through our sample, the failure rate goes way up. Okay, so there's a literature, right? People have looked at corporate bond liquidity. They've looked at it during stressful times, both in terms of what happened in March 2020 and what happened in the financial crisis.
Terry, sorry, a quick clarifying question before you keep going. So what happens if there's no trade? Is it the seller just holds on to the asset, or are they going to go try to find other people in some other?
So we have regulatory data. So this is not, it never becomes public, right? So this is effectively trace, but it was trace, it's like treasury trace. So the Fed gets it, but they don't, it doesn't get released. So we can't, like, you know, we see in the BWIC data, we see what the person is trying to sell. We see that it's reported that it doesn't trade. And then we look to see, well, was the same CUSIP later sold over the next 5 or 10 days? It just doesn't get sold. Okay, so, and then, right, we've got, you know, things that look at trading costs over very long periods of time. And it seems like the dealers are taking less inventory risk, which presumably means failure could be increasing, right? So in general, if you look at the corporate bond market, it's not obvious that trading costs are fairly constant over time, but it looks like it's become harder to trade. And then that would be consistent with an increase in opportunity costs, but they can't measure it. There's another approach you could try and take, which is related to Christian's point, is so if you, in some sense, I'm not sure that the liquidity supply function is all that well defined in an OTC market, but to the extent that it is, you could imagine that if I want to trace this out, I could look at times when people have to trade. So you get downgrades, you get index rebalances, so you get people who actually have to trade, they're going to trade, there's not going to be any selection bias, and you can look at how large the costs are there, and you could vary it with quantity. And so this is, people have done this in a couple of instances. It's useful. The challenge is, well, okay, this tells you about one little corner of the data, and you find out what people who really need to trade might actually have to pay. And then it's hard to find events where you're really sure, you know, that exactly how they work. But these are perfectly good places to start. And then you can look at that over time and do various things, but still you're only talking about a very specific group of investors. Then there's the question of how does that generalize to investors on average and in other ways. Okay, so RFQ and opportunity costs. So there are a couple of papers that have looked at RFQs. I did one, as I mentioned to Charles, they're 5 to 10 minutes. These are very short RFQs. They do fail some, but in these cases, you end up, it looks like the people are retrading. So here you see fail some, but it looks like people do eventually trade. So the corporate bonds are a lot more liquid. There are a lot more corporate bond dealers. They're going to be about 20 dealers in the CLO market, whereas there are 400 for corporate bonds. We didn't do anything to try and really attempt to estimate the costs for attempted trades that failed to ever occur. So then there's the CFTC paper that used CFTC data on CDSs, and basically the RFQs there almost never fail. So it was less relevant. So, people have thought about measuring, trying to do something about what the opportunity cost is. And Larry and Joel had a paper that now, I see 1996, and I can't believe Joel's really that old. But so they trying to look at limit orders versus market orders. And then they had some way of basically assuming that if it doesn't trade in a limit order, what you do then. So you can do this. And then there's a paper from looking at hidden orders on the Paris Bourse that extends this to hidden orders. So people have tried to think about this. But, when I talk to Joel about this, he's like, yeah, this is hard to do anymore because people just reprice limit orders and there are all sorts of challenges. But people have tried to do this. Okay, so CLOs, if you're not familiar with a collateralized loan obligation, your basic structured product, right? So these are loans. They're typically sort of leveraged loans. They get put into the CLO. Then as money they're divided up into tranches with your standard waterfall structure, whereas the highest rated ones get paid first, and then they all get sold off. So it's structured products typically like that. Now, so who holds the CLOs? Well, the different investors have different regulatory constraints and risk tolerances. So you get different investor bases across the tranches. So you get the banks and the pension funds are up in the high rated stuff. And then down in the equity tranches, you get people who should be, hopefully know what they're doing in terms of, you get sovereign wealth funds, structured credit funds, you get hedge funds. And so that's the general people. If you can see, I think this is from, I can't remember, probably from the BIS, that this was their estimate of the investor base as to, right? It lines up with what we have over here over who owns them, but this also gives you an idea of how much they own. And you can see this, the banks here, which are the big blue here, they don't hold on to any of the junk there. And it's really the structured credit funds and the hedge funds who are holding a lot more of this. Okay, so how big is the CLO market? I mean, the CLO market is like really important because the small companies who are riskier companies, this is a large part of the way their loans get financed. And I can't remember whether it's 60 or 70% of sort of small business loans or riskier loans end up in CLOs. So certainly, outstanding, right? The senior has gone up a lot. We're up to 400 billion. So there was 650 billion by the end. I've got these gray areas here, which are, this is the Euro debt crisis. This is, there was a credit event in 2015 and 2016, which I don't fully understand. You'll see it later in some of the other slides. And then we've got 2020 here at the end. And I have to say, I always find it remarkable that they're able to increase the amount of senior CLOs while the mezzanine and junior don't go up nearly as fast. The remarkable part of financial engineering. Okay, so what is our data here? So we're going to have data from 2012 to 2020. So Credit Flux is the data provider. And then we've got, as I said, it's a first price sealed bid auction. So done by email, it's a messaging system. It's more flexible, less standardized, 1 day to several days. So in general, only the seller and the winner know the actual price. So this is the trade price. This gets reported, but is never released publicly. So we can see it, but the market doesn't. When there is a trade, you get some information disseminated back to the market and including the losing dealers, and that's the cover. So the actual trade price doesn't come out, but much of the time you see a cover, which is the second highest bid in the transaction. If the BWIC fails, then it's disclosed as do not trade, and there's no information on price there.
Terry, a clarifying question: if the auction fails, does the seller learn the highest bid?
The seller sees the bids and then decides whether or not to trade.
Even
right?
if there's no trade. Okay.
Yeah,
Thank
even
you.
if there's no trade. The bank, right? I mean, typically these are run by the seller approaches one of the dealers or one of the banks, and they run it for them. And it's my understanding they don't commit to a reserve price in advance.
Terry,
sorry. Go ahead, Amy.
oh, sorry. I wanted to ask a similar question: is how often do you see responses with no trade?
So we don't see the bids. So in the data from market access, because it's all electronic and the company provided the data, we could see all the bids. Here, we don't see the bids for failed auctions. We don't see the bids for successful auctions. We see at most two things. One is a trade price, and the other is if this cover is what's disseminated back to the market, and we see that. So we've got data from Credit Flux, and then we've got non-public trace, and we're going to put those two together. There was another question?
Yes, Terry. So following on Joel's question, I'm wondering, do you think that sellers could run this auction just to get a sense of the market, right? To get an estimate of the price, because then what you might interpret as failure is just me realizing that I have the highest valuation for the security in the market.
You could, but I mean, at the same time, you're not anonymous to the bank. And so, right, there are instances in more automated markets where people, yeah, they may send out messages to try and get this a lot. In this less liquid market, I think that's less likely because the dealers view this as, you asking for a price is costly for the people to actually look at what the loans are in the CLO and decide what they want to bid for it. And if you're just sort of fishing around in there, there are likely going to be reputational costs. But it's hard to rule that out.
I mean, to some extent in your formula, the question is the R high because you have, is it mostly affected by liquidity needs or is it affected by private information, right? You might not pick up a quote because you have actually information and that information tells you not to sell, or it is mostly affected by your liquidity needs. And to some extent, both of these forces are going to affect whether you pick up the quote. And so the failure is really either, you didn't get to trade for liquidity reasons, or you really didn't want to trade because you had information that suggested at those prices it's not a good idea. So I guess the interpretation here is affected by the reason for trade or the reason for requesting a quote.
Well, I agree. I try and be agnostic about it. So if I have a high reservation value, then what do I care if I fail? Right. What's really costly is when I have a low reservation value and I don't trade. And that's what we're going to try and get at empirically, because indeed, that's an important thing.
Sorry.
Terry,
Oh.
Go ahead.
Just follow-up question very quickly. So do you sometimes find that this cost of failure is negative? So when you estimate it?
That would be odd. So no, but let's talk about how we estimate it, because I've got like 5 slides on that, because that is a big issue, and trying to estimate it. Well, in any event, given we don't observe the reserve price, that's going to be a lot of what we're going to try and do.
So Terry, a question: when people want to buy, they go through an auction like that?
So there are just, this is not the way that it typically, people aren't so likely, right? So OWIC is a term that exists in the market. They're just much less common. So offers wanted in competition. And so in the corporate bond market, if you wanted to buy a particular CUSIP, you could run an auction. But in these trades so seldom that it's typically, right, it's less likely to be the case that you go and approach a dealer and ask for a particular, to buy a particular security. And if they do that, they're less likely to actually run an auction.
So that means does it mean that the buyers are approached by the dealers then? Because it must be that at some point people are buying. I mean, dealers must unwind their position at some point. So there must be buyers in this market as well.
There are. And so the question is whether or not the buyer wants to initiate a trade. And if they do, those generally are done via the OTC search part. Right. So it's right. There are many, many people who may actually want to buy a CLO. There are, if I'm interested in buying a particular CLO, there are many fewer people who are going to sell it. So their search might make sense as opposed to just casting a wide net, because anybody can buy it. Only some people can sell it.
Sorry, Terry, could you just clarify? I might have missed this. What role does quantity play? I mean, do you buy an entire tranche? You buy half? I mean, how does that work?
So they're typically, you don't see a lot of order splitting. Typically people buy the entire order size. So, oh, you mean quantity. So I don't think anybody's selling the entire tranche. You get, let's see, the average size, the trade sizes are several $1 million here on average.
But is that's a standardized thing, or I mean, is that an important source of heterogeneity?
So as I said earlier, I think that, we do have a quantity variable in the regressions, and the coefficient is there and it matters. So quantity matters. Didn't seem first order to me, but I guess I'd have to go back and look to see how TCI measures by trade size and how bid-ask spread measures by trade size. It is there, and my co-authors can answer in the chat if they have time to look that up. Okay, so this was the statistic that Gideon put out there. The typical CLO trades 11 times in our sample, right? There's some senior trades slightly more often than junior, but you know, this is a 9-year sample. Not that CLOs necessarily exist for the whole 9 years, but this is an illiquid market. I mean, it's not the housing market, but in terms of financial assets, this is pretty illiquid. There's very little there's not a lot of interdealer trade, right? So you see a third of an interdealer trade for every dealer for a dealer buys. Whereas for, you know, if you compare this to the munis and the corporate bonds, it's 5 times as large or larger. So you don't see a lot of interdealer trading. It's usually, it looks like it goes to the final customer pretty fast. Okay, so what do we have here? So these are this is basically, I already showed you bid-ask spreads for 2020. These are bid-ask spreads for the longer time period, right? So this is, and you can see that spreads have gone down over time as the market's grown, right? I showed amount outstanding as that's gone up. Spreads have come down as the market has matured some. I think I already mentioned what the gray areas are. So liquidity is improving, right? The issue size for senior is a lot larger than junior. So, I mean, these are non-trivial tranches that are being sold. So maybe it's 10% of a tranche. And you can see the bid-ask spreads are on average pretty low. So the market conditions over this time period. So this is basically the leveraged loan spread, which is the spread of the types of loans that end up in these CLOs. And you can see for our 3 gray areas, it went up a fair amount. And you can see how large the spread is. So we're not talking, right? These are relatively risky loans. So this is the dealer CDS spread, which was really high during the Euro debt crisis and came down. But you can see this goes up in times of stress as well. And you can see that volume is increasing, just like with the amount outstanding, volume increases. But this also means that, you know, in these stressful times, we're going to see a fair amount of volume. And so volume-based measures may not tell us a lot about just how illiquid the market is, because people still trade. Although for junior, it looks like they have more trouble trading in bad times. So this is the data on failures. Right, so basically you can see we've got the number of BWICs and then the number of trades. So the BWICs are the solid line and the trades are the red dotted line. And for senior, you can basically see that you can barely tell the difference between them because these barely ever fade. Then for mezzanine, you can start to see a gap. And then for junior, you can see the gap is much more evident. And so basically the difference between there, which divided by the number of BWICs, is the failure rate. And so this gives you, this is graphed down below. So you can see we're looking at maybe, 10% failure rate for senior in the beginning, and it's less than 5% by in the last 5 years. Mezzanine became less likely to fail. Junior, I mean, so the fail rate here is going from 20 to 10%, but here it's 30% and it spikes up to 50%. It came down a little bit, but so the lower credit quality fails a lot more often, and it spikes up in failures a lot during bad times. Okay, so now to get to the estimation strategy here, right? So this is basically the slide that I put up to motivate us in the beginning. We've got the observed bid-ask spread, the fail rate, and then we've got the unobserved cost of trade failure. And so we don't observe R, so estimating this, right, if we had R, I guess we could try and see if there are any negatives, but that would be economically kind of surprising. So, right, we observe the bid-ask spread, so that's good. We observe fail rates, so that's good. We observe the expected bid conditional on trade, right? That's just, right, we're gonna see that. We don't observe all the bids, but we'll see that when it's greater than R. We don't observe R here. Now, if R is constant, we can get R, right? Because then we're gonna see a lot of bids, and the lowest bid accepted bid that leads a trade is the reservation value. So if R is constant, we can get that it's basically the smallest accepted bid we ever see. If R is not constant, this is where the challenges come in. So if R is stochastic, then we, the expected value of R is still going to be some quantile of the bid distribution. And the question is, what quantile is that? Okay, so this is really going to be the challenges, and that's what I'm going to spend a number of slides on. is how we're going to go about trying to figure out what R is. Now, so I said I'm going to sort of be estimating the TCI for the average seller. And it turns out we're going to be estimating a lower bound, and I'll talk about that. And some of you have seen the paper before. This is where we've given a lot more thought to what it is we're actually estimating, what we can estimate, and how we'll go about it, right? So we still have the, so right, so this is the same equation here. So for the expected value of, so now I'm going to think of R as being drawn from the distribution, where it's the expected value of R plus some epsilon of R. And so, you know, the challenge is going to be, in this case, then potentially all of these terms should be written as conditional on R. And then you would need to calculate the conditional expectations based on the unobserved R, which is going to be a big challenge. So, however, you know, we're going to be able to calculate this bound for TCI for the expected R, or the average seller, under somewhat mild assumptions. And it's just going to be that epsilon R is drawn from a symmetric distribution. So, and then, right, we can think about opportunity costs. So this first term isn't that large. So let's focus on the opportunity cost. So epsilon R is the stochastic part of R. And so then you can think of the fail rate conditional. So this is the opportunity cost, and conditional on for the average person is greater than or equal to the observed fail rate in the data. So these are the unconditional averages. So that just follows from these two things, that basically, right, the fail rate for the average person is, sorry, the highest bid is greater than the conditional on you being the average person is greater than the unconditional, and the same thing for the fail rate. So you can write the so we know that the expected value conditional on epsilon R is greater than or equal to what we have written up here. So what we're going to estimate is what's up here, but then we're going to interpret this as a bound on what it is for the average seller. Now, the other thing here is that, so because the cost of immediacy is decreasing in your reservation value, which we talked about earlier, that basically people with high reservation values, it's not going to be that costly for them to trade, because if they get a bad price, they just won't trade, and it's not that costly. So if we're estimating the cost for the average seller, and we're estimating a bound for that, half of the sellers in the market are going to have higher costs of immediacy than what we're estimating. And the ones with very, very low reservation values may have extremely high costs of immediacy. Okay, so to do this, right, we're going to use these three that we can observe in the data. We really have to focus on estimating the expected value of R. And that's going to be the challenge here.
Sorry, Terry, clarifying
ahead.
question. Okay, I'll go first. So when you say you observe the expected bid condition on a trade, I guess what we need is the counterfactual on the security if there had been trade on the security for which the trade fails, right?
Well, 100%, I'll get all this.
Okay.
Well, no, so the formula here is the expected bid conditional on trade.
But
So,
okay, but are we not interested, you know, in this quantity condition? I mean, for trades that do not happen, that fail. So, or maybe I'm missing something, but.
Well, so I mean, here, this is basically when I trade, I get this. When I fail, I hold on to the asset. So, you know, if the bid was really, really low, and I don't trade, I still get R. So it may not matter to me how low the bid actually is. I still have the same reservation value.
Well, shouldn't it be the expected value of R conditional on no trade?
Indeed. Well, so that is what I was trying to get at. That's why we're calculating a bound, right? So indeed, right, so if R is constant, it doesn't matter. If R is not constant, it should be conditional on trade. But you can basically, so let's see. So this is why we're doing the average R here, right? So for the median R, so here we're conditioning on the expected R. So then indeed, the reservation value is the expected value of R. So by saying it's for the average seller, we don't need to worry about conditioning on R, because we're giving you a calculation that's based on an R that we know.
But to come back to Vincent's question,
Yep.
I think you are going to use the distribution of the bids you observe when there's a transaction.
Yep.
To estimate the distribution of bids that you would have observed if there had been a transaction when there is indeed a sale. So there is an implicit assumption that those two distributions are the same. The distribution of bids when there are transactions is the same as distribution of bids when there are no transactions.
This is true. So indeed, we're assuming that there's a distribution of bids, and the distribution is the same across all transactions. You're only going to observe, right? There's going to be selection because you're only going to observe the bids when they're above the reservation value. So I've got a slide on this, and if it's not clear or you have extra questions, I'll have a graph and we'll talk about it.
So could you clarify whose information that you're conditioning on here, maybe?
So I'm thinking of it, we're conditioning on the sellers here, right? So I'm thinking of if I'm a seller and I have the average reservation value, what are my costs?
And then we're going to condition on some other seller because we're going to look at condition on epsilon is equal to 0.
Right. So
your second equation is a little confusing.
Well, so I'm going to try and measure for someone who, right? So you could try and calculate the expected TCI for an average seller, for averaged across all sellers. That's not what we're doing, because then you get this exact problem that you need to estimate the expected value of R conditional on trade. So if we want to do this from the perspective of a seller who knows their reservation value and in fact has the average reservation value, what are their costs going to be? So their opportunity costs, then we know we don't have to worry about this expected R term. We don't have to condition this expected R term here, because from their perspective, that's not from the econometrician standpoint, you know, we might want to condition when we observe the data, it's problematic, but from the seller who knows that his reservation value is the expected value of R, we don't have to worry about that.
Okay.
We still have to estimate it. And this is where we've thought a lot more, because indeed, all these questions have come up and they're excellent questions. And in the prior versions of the draft, we were much less precise about what we thought we were measuring. And hopefully you'll, what we're doing will be clear and even convincing. Okay. So then there's the whole thing about we're going to pool across the different BWICs that we have in the data. They differ by observables. So X is going to be our set of market and trade characteristics. And so we're going to parameterize the reservation value as being a linear function of this. We still have this reservation term. Then basically we're only going to be observing trading when the best bid price is above the reservation price for that, right? So if we want to, you know, basically for the average person, right, epsilon R is going to be 0. So then there's going to be some quantile, some probability that this holds. And so basically tau between 0 and 1 is the quantile that absorbs the epsilon R, or the one that is going to be that for if we do a quantile regression at tau star, it's going to tell us what the expected reservation value is. If we do a quantile regression on the bids, the tau star quantile, that will give us expected R. The next one is, well, then there's a question of how do we estimate it? But first I'm going to show you the graph. And this is where hopefully somehow I'm having trouble. There we go. So, and this is where hopefully this will answer Terry's question. So we've got basically bids and offers here graphed. And so we just simulated data. So all these dots represent a realization of a bid and an offer. And so you could think of them as I've basically eliminated all the expected part, and the expected part conditional on the observables. And what we have left here are basically the variation in expected in the expected bid epsilon B, and the variation in the reserves expected R. And so then the selection occurs because on this 45-degree line here, right, you're only going to observe these, only going to see a trade when you get realizations that are up here. When the reserve is above the best bid price, you're not going to see trades there. And so now you could think about, well, so the blue plus the cyan area is when we see trades, the red area is when we don't see trades. So now I have to think about, we have to think about how can we figure out what this, how can we back out this reserve price here? Okay, so then we go, right, we'll take the, we'll go up from R as 0, and then we'll go up to, you know, the 45-degree line, and then we come over here. So basically this is the mass of observations we have, all the cyan dots here. These are where we saw a trade, but the reservation value was less than the average reservation value. Right, so these are the ones where, so if I'm interested in, as Burton put it, whose information set I'm thinking about, well, we have this person, a reservation value. This person is never, we would not see a set of trades for this person in this region because the bids have to be above 0. You could do it for any R, but we just chose R, that's the average. And so then, now if I'm going to run a quantile, basically, this is the mass of this quantile of the, the mass of the cyan area relative to the blue plus cyan area. That is going to be the quantile regression or the tau star regression that will correct for selection bias. So you could, another way to think about this is, well, you know, if we exclude all this data down here, what's the lowest quantile? What's the lowest observed best bid we'll see? Well, it's going to be in fact 0. Right? Because we excluded everything less than 0. And so then that will measure it. And the tau star quantile does the same thing.
Terry, you have about 10 minutes left.
Yep. Well, this is the key part, and then there's the rest of it. And then we can go over, the results are what are I've already given you a prelude for what they are. Now the right one, so the right one, basically I've decreased the variation in R by half, right? So you can see how the cyan area gets smaller, right? So it's the variation in the reserve price that's causing all of the selection. So as the variation in the reserve price gets smaller, there's less selection to have to account for. As the if the variance of R goes to 0, there's no selection, and you would just look at the lowest accepted bid to give you the reserve price. I see you nodding, Terry. Is that a good sign?
So, well, I think, you know, the last thing you say makes the intuition very clear. If there was no variation, you would take the smallest bid that you have observed in the past. But you are assuming that what you observe when transactions were happening is what you will observe as the transaction take place when there is a fail. Which is the same thing as saying the distribution from which you draw the bid is the same when there are transactions and when there are no transactions.
Yeah.
Well, I agree with that 100%. I mean, without that assumption, it's like, I mean,
yeah, I agree. You would not be able to do anything, but I agree that this is one of the, that's an assumption.
I mean, it's related to what pins down the correlation between R and B, right? And we would somewhat expect that R and B are correlated.
So we're gonna go ahead. I mean, we're gonna pin down all the.
It's driven by information, right? That R is partially driven by information about the fundamental value of the asset, not by liquidity. Then if the market bids high, you have a high reservation price at the same time. So there would be underlying correlation between R and B in the graph, and that the degree of that correlation is important, I guess.
So right, we can take out all the correlation that's based on observables, but indeed, if there, and I'll show you the equations for what we do, and we're trying to think about trying to take care of that correlation, but that's getting to be a really deep problem, right? I think what we're making a lot of progress, but that is one thing that isn't quite there yet. So what are we going to do? And I've got 7 minutes, so I won't spend too much time on it. But basically, there is a literature that's sort of like the Heckman correction for quantile regressions. There's the first paper, which sort of lays out what to do. These guys really formalize it. And then Ariano and Bonhomme, they show how to do it with copulas. So this basic approach has been done in labor and IO, where they're trying to look at, they're observing wages, conditional on employment. So there's some potential selection there. They want to know what's the distribution of unconditional wages. And then in application, well, you could compare the unconditional distribution across genders, where you're basically taking out the selection due to employment, which could differ across gender. Bacchus has a paper trying to look at, well, what happens, right? You observe firms that exit conditional on their productivity. So you want to think about what's the unconditional distribution of productivity, and you're really trying to think about how does competition cause firms to increase productivity or cause low productivity firms to exit. So people have used these sort of approaches in a number of interesting settings. Their approaches are generally trying to debias an observable outcome, right? So we see wages and we want to get the unbiased estimate of wages. We've got in some sense, a bigger challenge. So we're trying to estimate the unobserved part, but we're following an approach that's consistent with the way that they've thought about it. Okay, so what are we going to do here? So we're going to need an instrument. I don't think this is identified without an instrument. So we're going to have a linear model for bids, a linear model for our unobserved reservation values. What's the probability we get a success? Basically, we get a probability of a success when the bids are greater than the reservation value, or we can rewrite this as basically, some distribution function based on S, which is X and Z, and that's the normalized expected seller gains from trade, right? So we've got X and Z in it, and then we're going to do this normalization here because we're not going to pin down the variation in the bids or the variation in reserve prices, but we are going to get something that basically tells us about how these these standardized errors are correlated with each other. And that's going to give us what the quantile is. Okay, so the second part is, right, so we've got this row here, which is the correlation between epsilon and eta, right? We're going to see a success. So we're going to see a success, and that's going to be tau star. And so what is this equation, right? It's got two parts to it. So this is a probability divided by a probability. And T star, this first term is the probability that epsilon r is less than or equal to 0. And the second probability, the second part of this is the probability that trade occurs. And then we divide it by the probability that trade occurs. So this is basically giving us that cyan region in the tau star. This is the cyan region, and this is cyan plus blue. So this is following directly from that graph I showed. I've only got 3 minutes left. So, but that pretty much wraps it up, right? So we've got a probit, which is linear in X and Z, and then we've got a GMM, which is just doing this. To get an exact tau star, we'll have to choose a copula, and that's what this Ariano and Bonhomme is there. So at this point, we've estimated it for Gaussian, but you can use other ones. Okay, we've got our instrument is dealer inventories. So these are collected by the Fed. They're not observed to the market until a week later. So these are presumably the seller doesn't know them, but the bidders do, which would be a good instrument. But you can never really defend your instruments. What are you really going to estimate? We're basically going to estimate our TCI here. We're going to get the average bid-ask spread, and we're going to get the failure rate and the failure cost. All of these are observable. We're going to have linear models in the data where we run them. And then the quantile regression is what's going to help us estimate the failure cost here, right? So when I talked about earlier, we'll do it similar. We'll do it separately for the different tranches. We've got our control variables. The estimate's going to give 1% for senior, 5% for mezzanine, and 10% for junior, which is not, which is consistent with what I would expect, that there may be a lot more selection in the junior, in the more uncertain assets. Okay, this is what it looks like. So this is basically, you could think of this as the bid. So it's the price discount. So it's how much, these are all relative to par. So here, this is the distribution of the best bid. This is the estimated reserve price. So we've got it for senior, mezzanine, and junior. And so the gap between the two lines is going to be the failure cost right out of our equation, right? So the difference between the best bid and the estimated reserve price there. Now this region here, the highest one is 1%, the middle one is 5%, and the lowest one is 10%. You can see it doesn't matter that much whether you're at 5 or 10%. It matters some for 1%. So you can see the failure costs are pretty substantial for mezzanine and junior, right? It's like, well, here it's 5%, and here it's more like between 10 and 20%. Okay. So now putting those, basically putting together our failure cost. I already showed you the failure probabilities. So you put those together in our formula over time, and this is more or less what you get. You get TCI for, right, so this red here is the bid-ask spread. The blue here is the TCI for the different quantiles. And so this one you would use 1%. This one you would actually use the blue line, which is 5%. And this one you would use the lower part of the blue region, which is 10% there. And you can see the TCI is much, much larger across all of them. And here it's at 5 or 10%. So the TCI is much larger than the spread. It increases in the lower tranches and it increases in bad times. So this provides all the details for the pandemic for the graphs I showed earlier, but basically what's really happening here is, as I said, failure rates went up to 60% for junior in the pandemic, and that's really what drives the increase in TCI there. Okay, 10 o'clock, or 1 o'clock, or for Terry, it's 7 p.m. You should be drinking wine by now. So let's see, to try and wrap this up. Right, so, and I focused a lot of the time on the challenges of measuring illiquidity and TCI, particularly on the opportunity cost. So, you know, when traders are selling, when the bids are low, we get these issues in centralized markets. So we're using these endogenous quantile estimates to estimate the failure of a trade. And Burton's question is good from whose perspective? We're looking at it from the perspective of an average seller. And so the TCI is a lot bigger than the spread. The gap is bigger in the lower rated CLOs and stressful market conditions when you get these high failure rates. So the observed trade cost is only a few basis points for all across tranches. TCI is still low for the senior, but TCI can get very, very large for the junior ones. Then you can ask, well, you know, is the BWIC actually a good mechanism? Why does it take so long? You know, there's the general question of, you know, when we think about illiquid assets in crises, are we just systematically underestimating just how illiquid the market is? And for the Fed, they care about this a lot. The SEC might even care about it. Then, you know, and then there's a question of, well, you know, how stable are these CLOs? If in bad times you can't sell them, who should really be holding these junior tranches? If, you know, are they going to be able to actually make good on redemptions? Okay, so Bachimeg, 2 minutes over. That's not too bad. Hope I didn't, if people have questions about the slides at the end, I'm certainly happy to go back with them, but go back to them.
Yeah, so Terry, quick question. Can you go back to the slide where you look at the bid and the reserve price? Yeah, so you just passed it. The graph with the bid and the reserve price.
Yeah.
It seemed that the reserve price was highly correlated with the bids. Now, I didn't quite get the intuition for that. Should the reserve price of a seller change with what the bids are coming in?
No.
If you look at the graph.
An average person, a seller with the average reserve price, then what do we think his costs are? So no, we're thinking of the seller has a reserve price and it's not conditional on the bids. That would be,
yeah.
I'd have to really think about that. But I mean, this is, we're thinking of the standard auction model. I've got a reserve price because that's what it means to me if I keep holding it. And then if the bidders come in above that, I'll sell, otherwise I'll just keep holding it. And my reservation value is my utility from continuing to hold it.
All right, so we'll open the Q&A segment for the audience members. If you have any questions, please use the raise hand feature. In the meantime, let's have Marzena, Hakushang, and Joel. You want to go ahead and ask your question?
I have a quick question. What is a possible takeaway for theory as you see it? Is it, hey, let's try a little harder to write better models, or perhaps there's nothing missing in the models we write, and simply analogously to how price level is not a good indicator of liquidity in other classes of models, let's say models based on submission gains, we should be looking at other statistics. The bid-ask spread is not a good indicator or a complete indicator of illiquidity as well.
Right. So, I mean, I guess the one unanswered question is, how do we think about, when there's no trade? And so this is related to Christian's point earlier on. And he was just like, okay, look, everybody trades. It's just a matter of what price you get and how long you have to wait, which is a standard way of thinking about liquidity. It doesn't seem to apply in these settings. It looks like you see people who just never trade, and you see some really low prices they accept. So I mean, that's one way to think about it is, should we actually be thinking about, what does it mean in a market where when in bad times, the market really freezes in the sense that you can't even get a decent bid.
Right. Thank you.
All right, two questions. So the first one is, in the auction, it's by email, right? So presumably, the seller is going to email everyone.
So the seller, I mentioned this briefly, but I didn't dwell on it. So the seller has a bank runs the auction for them. So no one knows who the seller is. So someone says, well, we've got somebody who is who wants to sell this QSIP and this quantity of this QSIP and bid.
Do the bidders know how many bidders are in there?
No. Well, they probably, I mean, there are only 20 dealers.
So the reason I'm asking,
I think how many, I think pretty much everybody is solicited for the BWICs. So it's not that, go ahead.
If preparing the bid is costly, then the optimal thing is not to get everybody to bid. I think there's a theory paper on this. You can kind of get the internal. I mean, there's a model. I think somebody wrote. Basically, if you have a costly participation, then the optimal number is actually not n. So it seems that maybe an obvious potential improvement is that to limit and kind of experiment a bit of that. If you believe that bidding is costly.
So I agree with that. And that might be why there are only 20 dealers in the market. So the first thing is that might really limit the set of dealers. And then you might want to limit it even further in an individual auction. And Dan knows more about the details of the exact, has talked more with the practitioners about how they do it. But it's my understanding that it goes out to many of the dealers, but there aren't that many to begin with.
Oh, okay, right. So the second question is, do you have any out of the model verification for these values? What I have in mind is something like, if you just track the cash flows of CLOs and discount it to present value according to the market discount rate, whatever, which you can estimate based on the BWICs that actually trade. So that's kind of outside verification of the R. If you think about what's the fair value, right? I think you're asking almost like kind of a fair value question. Because everything right now depends on the model, and this number is really big. It's kind of hard to say to really believe these assumptions.
Well, I mean, you see they fail 50% of the time. So clearly, I mean, a lot of it's being driven, a lot of these fail costs are being driven by the failure rate going up. So you don't necessarily need to, which is something that's observable. Let's see.
Oh, right, I see, yeah, okay. So,
right.
so basically
there's some variation in the fail cost, which is coming from our estimation, but that's not what's really driving the big spike in the cost of immediacy. It's the fail rate going up. Because you would expect that in bad times, the bidders lower their bids and the sellers understand that and they lower their reservation values, which is what you're seeing here, right? These co-move together. And we can take care of this sort of co-movement because this is based on observables.
I see. So the main takeaway sounds like the main takeaway from the estimation is that the shade is pretty narrow, right? No matter what quantile you use. If you use reasonable quantiles, it's such a narrow range so that everything is driven by the fail rate. Is that sort of the takeaway? So
I don't know that it would go that far. I mean, I think intellectually trying to estimate this precisely with the selection, I didn't realize that there was a related literature, and I find that very interesting. But indeed, it looks like it's you know, it's, except here, here's is getting pretty big, but most of the time it's the correction for selection is, you know, not changing so much over time.
Okay, that's cool. Thank you. Yeah.
Next, Joel, go ahead, and then after that we'll go to Gideon and then Amy. Also, co-authors, if you want to jump in and answer questions, feel free to do so.
Yeah, I'm happy to stop talking if.
Thank you. I was struck by the fact that the seller does not disclose their reservation price in advance. My intuition is that the bids would be very informative about the value of the asset. And it would seem to be, if the bidders were worried about this information being used against them, it would seem to me to be very easy to design a mechanism where the seller would pre-commit to a reservation price. So I have these conflicting intuitions here that the bids should be very valuable information, and yet the mechanism design does not require the seller to disclose the reservation price, even though it would be very feasible to impose that restriction. Do you have any sense about what's going on there?
Okay, so a couple of things. So one is related to the first question, which was what, you know, how should theorists think about this? Theorists can really think about exactly your question of what's the optimal selling mechanism here under all these different things, because you're providing your intuition that you think the reserve price should be disclosed. I guess I'd have to think really carefully about how that would happen. So if I'm a desperate seller, am I going to disclose the fact that I'll sell no matter what the prices are when there aren't that many dealers bidding in the auction? That doesn't really seem like an equilibrium. So I assume not everyone would give their reserve price.
Yeah.
Now, I guess the next thing is if the auction is going to take, you know, 1 to 3 days, can I really commit to my reserve price for that long a period of time? Which I think would be a little tricky as well.
Well, you have bidders committing to their bids.
But they can revise them.
Okay, all right.
Right, so it may take 3 days, but you know, and these are also variable rate securities, so you're not taking any interest rate. But if you think for some reason that particular CLO has changed value, sure, you can just email the person running it and you don't have to worry about information transmission because it's sealed bid.
So Terry, when do I commit to my bid?
When the auction closes. So there's a deadline for the auction. At that point, it's going to be problematic if you backed away from it after that.
Thanks.
All right. I have a comment and a question. You know, when I heard Malzina ask her question, I mean, the point that you're making that, you know, when investors choose not to trade because the price in the market not attractive, I think it's very important in OTC markets. And Hao Jiang and Ron Yang and Jian San and I have a model that we coach in terms of a corporate bond market, but again, it's OTC, where you can, you know, look at the welfare of investor, taking into account what happens when, you know, they don't trade because they don't see attractive prices, or to, you know, Christian points that it takes too long to trade, right? The idea of immediacy. And we definitely see that measure behave differently than your realized transaction cost measure. And I think it's important to take care of that, especially if you want to make policy implications. Right? For policy implications, it's very important, that was kind of to Mazena's point, to take into account that component. So that's the comment. The question was, so the BWIC trades are about 40%, if I remember correctly, kind of the numbers from your paper, of the customer sell to dealer trades. So you developed this measure using kind of the special BWIC structure. So do you think that the cost of the other 60% are similarly understated? So we need to use the same factor to adjust them? Or are BWIC somehow special because there is selection, so we shouldn't treat those 60% in the same way?
So yes, that's an excellent question. And, it's hard to, I guess we could try and compare the prices we see in the OTC to what we see in the BWIC, but that's hard because these are so illiquid that we're seeing them at we'd see them at very different times. And that's an interesting question of, is it which type of customers do BWIC versus not? And, could it be that the motivation is different, right? I would think that in our BWICs, these could arguably be the less informed sellers, because they're willing to risk the fact that everybody knows they're selling this particular CLO. Whereas I could imagine the people who are more worried about information leakage on their order would go to the OTC market. So it's possible that these are even larger in the OTC market, because there people may really want to sell because they think the dealer's bids are going to be mispriced. But it's, I could speculate in all kinds of ways. But it's an interesting question.
Yeah, so Terry, I wanted to follow up on this idea of thinking about what no trade means to liquidity. And I'll bring up another situation where we see no trading, but you have lots of liquidity. And that is in, say, the very low risk, low credit risk corporate bond market, where the idea is it's very liquid because the dealers have no problem taking on inventory because they can hedge it very easily. And so when you take that idea and bring it over into your situation, I think it's great to be able to observe these failures. But I wonder if the reservation price can have something to do with hedging as well. How easily can the dealer offset their positions?
Okay, so right, it's certainly the case. We don't even really have a model, but I mean, we've got some intuition. You can write a model, but in the model, as you typically do in auctions, you think of you could start with valuations, and then you would get the dealer's bidding. And you could imagine that the dealer's ability to hedge or their balance sheet they have is a lot of what's driving the bids. And so when you see how much this changes over time, that's certainly support for the fact that, dealers are, certainly over time, and then in bad time, over time, their bids have become in some ways more competitive. And that could be because it's easier to find a counterparty on the other side, or because their hedging costs have gone down as they understand these better, right? Because the way you generally hedge this is in the high yield bonds, because there's a fair amount of correlation there. But I'm not sure I answered your question.
And I think maybe the hedging costs could be lower for the customers as well. So if their alternative to trading is hedging, then that'll affect the reservation price.
100%, right? Because it's the cost of me continuing to own the asset. And if I don't want the risk that's associated with it, well, I could just hedge it. Now, of course, if I'm a hedge fund and I've got a redemption there, then I really have to sell. But yes, for someone who's just thinking about the risk exposure and doesn't have big liquidity needs, the outside hedging would matter a lot.
All right, so we'll end the talk just formally here. Thanks a lot to Terry and everyone for joining the talk. We're just gonna finish the recording, but feel free to stay on and chat more.
Thank you very much for all the questions, and anyone who wants to stay on and talk more.
Okay, I have a
Go ahead,
Minnie.
Very quick question related to the earlier question about the fail rate. So you said that you observe fail rate from the data